trades for the exact same reason. And what is that reason? To make money, right? And I have yet to meet somebody that actually consciously put on a trade before they put it on thinking it was going to be a loser. I have not met that person yet. Now, I'm not saying subconsciously they didn't hope that it was a loser for some reason or another, but at least consciously everyone trades for the exact same reason. Now, so we've got everyone trading for the exact same reason. We've only got two outcomes to every trade that you put on. It's either going to be a winner or a loser, and there are only two ways to make money. You have to buy something low and sell it back at a higher price, or sell something high and buy it back at a lower price. Those are the only two ways that you can make money. Now, if that's the case, and the last price of something was 10, where everyone agreed, at least in that moment, two traders or more agreed on the value of something, what is going to cause the price to go to 11 or down to 9? Imbalance. Okay, you're saying imbalance, that is correct. That's right, okay? That is absolutely correct. But let's be a little bit more detailed here.
More demand than supply.
Well, okay, you could, I'm not going to argue with that, but that's not the answer I'm looking for.
More buyers and sellers.
That's not the answer I'm looking for either. Perceived value, yes, okay, that's close. That's
Trade.
what?
Trade.
Look at it this way, guys, okay? If for someone, if the last price of something was 10, for the price to go to 11, it means you've got a buyer and a seller, right? You've got someone who sold it at 10 and someone who's willing to buy it at 10. Now, someone who was willing to buy it at 10 is doing the exact opposite of what they need to do to make money relative to the last price. Now think about this for a second. The last price was 10. Low, if I've got to buy low and sell high, or sell high and buy low, low is 9. The last price was 10. Low is 9 relative to the last price. If I'm willing to buy at 10, what does that say about what I think that where prices are going to go? What? Yeah. Yeah, when you say perceived value, exactly. In other words, let's look at it like a football game, a basketball game, a prize fight, or whatever. We look at, everyone talks about, let's say, the word momentum. Who's got the momentum on their side? If you take these two traders, the guy that's selling it at 11 is doing exactly what he thinks he needs to do to make money. He is selling high relative to the last price. He is being passive. This is what's critical. He's being passive. Remember that everyone trades for the same reason. Go ahead.
Why does the person selling have less of a conviction? I'm not hearing you correctly. You said that the person willing to buy it has a stronger conviction.
Well, let's put it this way. I'm not saying that the seller has less of a conviction. He could have a very strong conviction and think he just got a deal, right? All I'm saying is that we can say, and that could really be the case, and that kind of conviction can stop prices on a dime, can it? Okay, so that could be a reversal right there. All I'm saying, David, is that if you look at these two people, you could say that the guy that's willing to step out and step up and bid a price up let's say, you're right, he doesn't have to have a stronger conviction, but for prices to keep on moving up, then we'd have to say that the buyers have a stronger conviction than the sellers. They have to, because they're willing, because one, not only are they willing to bid the price up, but that the conviction itself might not be as strong in this case. There might just be more buyers than sellers. So it's a combination of two things. It could be either there's a stronger conviction, or there's more buyers and there's not enough sellers to absorb the buyer's orders, right? And if there's one at the point at which there's enough sellers that come into the market to absorb all the buy orders, then what's going to happen? The price is going to reverse. So it can be a combination of two factors. It could be just numbers or conviction itself. But to make the point, what I do is I just usually say conviction, because really all price movement is a function of what people believe about the future. That we can say for sure. There's only two ways to make money. You have to buy low and sell high and buy low. And for the price to go from the last price to this price, someone has to be willing to step out and bid it up and pay more than, do the exact opposite. That's the important part. That's why I say more conviction, because he has to do the opposite of what he needs to do to make money. If I'm only doing this to make money and I've got to do something that's opposite relative to the last price, then that is an indication, okay, that, let's say, that's an indication that there must be more conviction, at least in that moment, probably. What's that? Okay? Okay, so what we have is we have now a group of people that are trading with one another, and as a result, this collective group of, now we look at it from a collective level, this group of people that are all acting, let's say, in their own self-interest, trying to make money for whatever reason, by bidding prices up or offering them lower, they create behavior patterns. They create group collective behavior patterns. Just the same way individuals will act the same way under certain circumstances over and over again, groups of individuals will act in ways, or let's say characteristic ways, over and over again.
Is it possible to draw energy out of a belief so that it doesn't have any impact on the way we see the world and how we behave? We might not know the underlying energy dynamics of how it happens, but we definitely know that it has to happen, because there isn't anybody in this room that is operating out of the same beliefs and principles they operated out of as a child. And then, I mean, in other words, there's a lot of principles and things that we knew or thought we knew or believed as a child that we no longer believe because they're no longer useful. Whatever those beliefs are, whether we remember them or not, if we could do an inventory of all the things that we learned to believe at some point in our lives, we will find that a lot of those beliefs, just the energy was inadvertently drawn out of them. If the energy was not drawn out of them and we've learned something new that contradicts it, it's what I'm going to call an active contradiction. And many of us, all of us actually, can have a number of what I like to refer to as an active contradiction. For an example, in Trading in the Zone, I give this, about the boy and the dog. The example of the very first experience a child has with a dog is very painful. He's mauled pretty severely. And as a result, every dog that he encounters, throughout his childhood, regardless of how friendly the dog is, regardless of the potential fun that the child can have with playing with dogs, his perception of what dogs are is that they are mean and dangerous. At some point in this child's life, he will most likely, this is hypothetical, but most likely develop a belief, a series of words that he's going to put together that have meaning in the sense that they're energized as a living concept, that all dogs are dangerous. Okay? This is a belief. All is an example of a belief. It's an example of a set of words that we pull together into a concept that becomes a life principle that has energy. And that energy that's inside of him will cause him to see the world in a way that is completely consistent with these words. So that every dog he encounters, he will perceive as being dangerous and avoid, regardless of what the potential is, regardless of what the alternatives are. It won't matter. This is something that can really frustrate parents because they could bring home the friendliest, most playful dog imaginable, and it won't make a difference. And parents will get frustrated because they think that, somehow or another, the energy of their words is going to counteract the energy of this terror. Because it's exactly what the child experiences every time a dog comes into his field of awareness. And this can go on like this for the rest of his life. At some point, he will most likely become exposed to a friendly dog situation. Now, I set up a hypothetical situation in the book where he's just, walking with his parents. He feels safe, and they walk around a corner that, he can't see what's going on, and all of a sudden he's confronted with information that is completely contradictory to what he believes is true. This is an absolute truth to him. It's not true from the environment's perspective. From the environment's perspective, dogs have a range of behavior. They're friendly and fun, and some can be mean and dangerous and everything in between. He walks around this corner with his parents, and all of a sudden he's confronted with a scene where several, and I'm going to say kids his age, and it's important that the kids his age part is a part of this dynamic because he's going to relate to them. And he sees these kids playing with dogs and just having a great time. They're laughing and they're running and they're jumping and everyone's having fun. This is completely contradictory to what he believes to be true. Were you going to say something? Anybody going to say something? Oh, okay. To what he believes to be true. This is now setting up the dynamics of what I'm going to call an active contradiction. He has an awareness that even though he might not relate to it in terms of the actual words, I believe that all dogs are dangerous. And he might say it that way. I mean, he just might, have this concept embedded in his brain with these words. What's happening is that his awareness that all dogs are not all dangerous, because he has a personal, direct experience to see that they're not, will start to chip away at that energy. Not enough for him to go approach a dog, not enough for him to play with a dog, but at least it'll chip away at it a little bit. Now, here's the important part of this, and this is the key element to any kind of personal transformation. It depends on what his intent and desire is. Now, if this kid, for whatever reason, he's relating to these other kids so much, and he gets so attracted to the fun that they're having, says to himself, I would like to be like these kids. I would like to be able to play with a dog. Not everyone's going to have that. Not everyone's going to have that attraction. But in this case, let's say this individual looks at this scene and says, you know what? They're having a lot of fun. And he's thinking, I want to be like that. Does that automatically mean he's going to be able to play with dogs? No. No, this fear is just way too intense. So he's going to have to set up a process, you might say, okay? Set up a process, like small incremental steps to be able to get to the point where he can actually interact in close proximity with the dog. And just real quickly, just how the fear attracts the object, the object of our cause the focus on object of fear, create the fear experience we're trying to avoid. Like this kid was, let's say, so afraid of dogs that he could even be walking out onto his front porch because some kids, his friends were in the park across the street or across the street at a neighbor's kid's house, and they're playing. He could hear a dog bark down the street, which under normal circumstances he probably wouldn't even be aware of. And hearing the dog bark would cause him to go back into the house. He created the experience. He wants to avoid dogs. He heard a dog that he ordinarily wouldn't be aware of, created an experience of terror, and walked back into the house. So how does he get through this fear to be able to express himself? How does he transcend his fear to be able to express himself in a way that he can play with dogs? It'll probably happen in slow incremental steps. In other words, now every time he encounters a dog, he will be seeing the dogs from a different perspective because he's already seen that it's possible to have fun. He just can't do it yet. And so every time he has a dog comes into his field of awareness and it turns out to be a friendly dog and nothing negative happens, he'll start building up positive energy into a new belief system that dogs can be friendly and fun. Yeah, I'm saying dogs can be friendly and fun. That implies some. Friendly and fun. Two contradictory beliefs. Every time he has a positive experience, he starts adding positive energy to this belief, to this concept, and he's drawing energy out of this one. Little by little, incremental step by incremental step. Eventually, if he does this long enough or it happens enough times, eventually they'll reach a threshold point. A threshold point in which the negative energy in this belief is probably equal to or close to the positive energy of this belief. And at that point, he might have enough desire to cross the threshold into actually petting a dog, into actually touching a dog for the first time in his life, other than the first one where he got mauled, which, but petting a dog, and the point at which he actually has physical contact, pets a dog, without it being a negative experience, it'll start drawing tons of energy out of this one right here, because then he knows for sure it's not true. All dogs are not dangerous. See, it's the all. It's the all part. It's not true. So it's not like the belief itself disappears. Do I still believe in Santa Claus? Yeah. It's a part of my identity. It didn't disappear. Once a belief exists, we're going to have it our entire existence. Once we formulate a belief, we'll have it. It's just a matter of how much energy is inside of it. That you can draw so much energy out of a belief that for all intents and purposes, it might as well not exist, because it has no potential to act on how we see the world and how we behave. So the whole time that he's going through this process of drawing energy out of this and putting energy into this, he was operating out of what I call an active contradiction. It's just like, as traders, we have an active contradiction. Most people believe that because they're traders, they're risk takers, when all their beliefs are lined up in a way that's completely contradicts what they think they believe. The idea that we're risk takers is an illusion. That's just something I'm a trader, I'm a risk taker. Well, if I'm a trader, I must be a risk taker. And yet if I analyzed everything I do and how I think, it would definitely indicate that, no, I'm not taking any risks at all. Otherwise, I wouldn't be doing it. Just like people who play slot machines. If there was the same kind of emotional risk playing a slot machine as there is with people who trade, do you think that tens of millions of people around the world will be playing slot machines every day? Come on. Do you think they would or not? Absolutely not. They're losing and they're having fun. But because they're really not losing. They don't look at it that way. They're paying for their entertainment. They're paying for their entertainment. They're paying to be surprised. And it's all right. They're not losers. They're paying to have fun. As traders, we have to pay expenses. We have overhead expenses. This has nothing to do with losing. Get that firmly ingrained at the core of your personality and you will be free. So my friend over here says, the truth shall set you free, and it will. Are we getting the concept here? Now, is this kid, as he's going through this process, does he have to have some sort of a comprehensive understanding of the dynamics as I've outlined them to you? No. He just has to have what? The desire. The key to transformation is desire. And clarity. Clarity first and desire. You have to know exactly who you want to transform yourself into and why. Our beliefs, beliefs just don't, they can go, you can draw the energy out of a belief instantaneously if there's enough desire. However, you have to be real clear about what it is that you have the desire of. It can happen instantaneously. With intense desire, clarity, and intense desire, it's like that. The degree to which you don't have clarity and desire, it will take time. And so I'm giving you a technique that takes time. There isn't anybody in this room that hasn't had a situation or experience in their life. I'm assuming there isn't. I really doubt that there is. There isn't anybody in this room who hasn't had the experience of making up their mind and things changed instantaneously. Genuinely making up your mind. That's in essence exactly what I'm talking about. When you really make up your mind with a resolute desire, with no conflict about what it is that you're making up your mind about, things change now. Anybody want to contradict that? You're going to argue with that with me? You can. No, I'm serious. If you do want to argue, I'll engage in an argument with you. Am I talking about anything different here? With this exercise I'm about to give you? If you want to instill these concepts that I gave you earlier as trading principles, you'll do it. You'll find a way to do it. If you don't, you won't, and it's that simple. If you can make the connection, you can make a clear, discernible connection between these principles that I gave you and the kind of outcomes you want to experience as a trader, you will do it. If your desire is to be a consistently successful trader. If your desire is to get out of the boom and bust cycle and the frustration. But keep in mind, not everybody wants to be out of the boom and bust. Not everybody wants to be out of the frustration. There's other agendas that can be, be asserting themselves. I had an options trader in the options pit years ago that I worked with. I mean, this guy had, John talks about a hero complex. I mean, this guy had a real hero complex. He'd set up the most convoluted option strategies that were just so unbelievable, and yet, and he did it for the express purpose of just going through the process of being the hero, of unwinding it in a way where, he managed to make everything all right. In other words, at some point when he set these things up, it looked like it was going to be disaster, and then he'd find a way to work his way out of it, and that's what he enjoyed. He enjoyed the complexity of it. Didn't help his equity curve much, but that was a secondary agenda. Okay, it wasn't his primary agenda. So, you want to instill these beliefs? Here's the way you can do it. The first thing you're going to need is a truly mechanical system. And what I mean by mechanical, I mean absolutely, strictly mechanical, no judgmental wiggle room whatsoever. Every entry and exit is absolutely precise. The market either conforms to the criteria of your edge or it doesn't, and there's nothing to decide. It's either there or it's not. Meaning that my entries are precise, that you don't have to make a judgment. Well, is this really an entry? Do I have, do I have this and this and this to consider? There's nothing to consider. This can be a pattern recognition system. It can be a mathematically based system. It doesn't matter as long as your entry, the way you enter the market, either long or short, is absolutely based on precise rules that you don't have to make any judgment about. Where you put your stop for a trade that doesn't work has to be absolutely precise and in the same place every time. In other words, based on your entry rules, there will be a most optimum place to put a stop that says that, there isn't much point in staying in this trade once the market gets this far against my original position. That does not change over the 20 trade sample size, because you're going to trade in sample sizes. We're going to be doing this in a 20 or 25 trade sample size. So where you put your stop has to be absolutely precise and consistent, meaning in the same place every time. In the same place in relationship to your entry every time. Not the same place on the chart every time, obviously. Profit objective, same rule. Precise, no judgment. Now, how are you going to find this system? You can develop it. You can buy it. You get it out of a chat room. I'm not saying that this is necessarily an easy exercise. Easy in the sense that finding a completely mechanical system where that has, they exist. They really do. One of the things, when my new book comes out, one of the next projects is going to be to make available a number of absolutely mechanical systems that fit the criteria of this exercise that people can choose to use to do the exercise. So in a number of different time frames and different styles of trading. And I've already got one. I got one that said the entries are really good. I just haven't made the excess precise in terms of stops and profits. So I am working on it. And is that going to be in the book? No, that'll be web based.
No,
Yeah. The book, because it's like there's no point in making these concepts available to people unless you're going to also help them with the system itself. Normally, if this were 15 years ago, I'd have said, you know what, figure out a way. It's like, you trade for, been in the business for 30 some years, and you think that, it's like you don't have to do everything. But yet, I realize now that I'm really going to have to provide it, or give at least people a way to find it. So it's just because the reason why it can be difficult. Not everybody is in a, let's say, has the personality makeup to be able to develop their own mechanical systems. It's just that simple. So yeah, I'm definitely gonna make, and not only that, not just me, but I will also, investigate other people who have already developed systems and, take the best ones and endorse them. Just say, hey, go here, go here, go here. So that you have this available, so that you can get right into it. So you don't have to worry about even developing it yourself, that you can just step right into the process of being able to do this exercise. So the next part of the exercise is to test and be tested. You have to back test or forward test. So for example, if you have backtesting capability and you're proficient at it, then you can go ahead and backtest. If you don't have backtesting capability and you're not proficient at it, then you have to forward test. So what I mean by forward test is you forward test in a simulated account. Meaning you want to find out what the results are going to be over, and believe it or not, you're going to forward test. I don't think you really have to forward test beyond 50 trades. All you need is about 50 occurrences of your edge to determine whether or not it's viable. You don't need to go beyond 50. So even if somebody is offering you a completely mechanical edge that you can buy in a chat room or otherwise, if they'll give you at least, at the very minimum 25, but if they'll be generous enough to give you a 50 trade sample, that would tell you whether or not you want to get into it. You guys with me on this? So you test your edge and you find out what the results are. It's that simple. It's like how many winning trades, how many losing trades, and what your profit and loss ratio is. Because there are some edges, that you can have, they might only win 35 to 40% of the time, but, their profit to loss ratio is so good that you're going to end up a net winner. And there are edges where you're going to win 90% of the time, but your profit to loss ratio, meaning you have to risk a lot to make a little. Where you might, let's say in the S&Ps, and I'm even speaking of one particular edge specifically that I know of, where they're risking 8 to 9 S&P points to only make 2 or 3, but they're winning 90% of the time. Now this might, this is, a lot of people wouldn't like that. That would be all right. Don't choose that edge. The important thing is that you get, once you decide that, once you found something that you think that you believe is viable based on your testing, then you're going to step into a process of actually executing the edge. Now, how you step into this process is a lot to do with your own, it's a innate, risk-taking ability. Meaning that there's a lot of people who are trading who are not natural-born risk-takers. I believe that there are genetically people who are genetically predisposed to take more risk than others. And the ones that are predisposed to take more risk generally will make better traders, or easier for them to be better traders, as long as they can control themselves. If they can't control themselves, they're going to be the worst in terms of their swings and up and down. But otherwise, I also, have worked with people who are so risk adverse that they can't even execute a mechanical system in a simulated account where there's nothing at risk and actually do what they need to do. They can't do it. They literally can't do it. Not even where there's no money. There's no money at stake. There's nothing at stake, and they still can't follow the rules. And if that's the case, then it's going to be challenging. Okay, it's that simple. It's going to be challenging. And so here's what you do. It's like if you can't do it with money, if you can't do it in a simulated account, because the first thing you really should do it in a simulated account. If you can let's put it this way. Here's the rule. The rule is that once you decide on an edge, trade at least one sample size in a simulated account. If you can execute that edge perfectly, and what do I mean by perfectly? You take every signal as it's given without making any errors. It's that simple. Your entries are without error, and your exits on the profit and on the loss side are without error. In other words, you can do exactly what you need to do when you need to do it. The only thing that's going to stop you from doing exactly what you need to do and when you need to do it are contradictory beliefs, or beliefs that would contradict what it means to think in probabilities. If you don't have any beliefs, or any beliefs that have energy that contradict with the set of beliefs that I gave you earlier, then you will be able to do this perfectly. And I would say the likelihood of that is probably 0. And so you execute in a simulated account until you can do it perfectly. Now, why are we doing this? It's important because you're going to think, you know what? I'm going to take time away from trading to do, You're doing this to develop the necessary belief skills that you need to be a successful trader. You are going to be inadvertently, well, not even inadvertently, consciously drawing energy out of any conflicting beliefs, and you don't have to know what they are. You do not have to identify them. You do not have to go into some sort of personal inventory of your beliefs. You don't have to do that. You just have to be committed to do the exercise, and it'll happen automatically. Every time you do what you need to do, when you need to do it, in spite of the fact that everything inside of you is screaming something different, don't do this, and you step through it and do it anyway, you will be drawing energy out of whatever conflicting beliefs were saying not to do it, or to do it in a different way, and adding energy to your new beliefs about probabilities. Are you with me on this? In other words, step, as best you can with as much desire as you can generate, step through the resistance. And just do the best you can and keep on doing it until the resistance goes away, because it will. There's an example in, and I didn't elaborate on this example in the Disciplined Trader, where there was a guy I worked with, he owned a couple of construction, this is back in the late 80s, he owned a couple of construction companies in Dallas. He was in his, mid to late 50s at the time, a real kind of a rough construction guy, right? He owned 2 construction companies, and but he started trading bonds away from the floor, getting his ass kicked. And so he said he's going to come to Chicago and be in the bond pit. He's going to be a bond trader. So he bought a seat, and he's trading on the floor in the bond pit and still getting his ass kicked. And somehow, I don't know if he read the Disciplined Trader. Somehow he ended up calling me, and I started working with him. And one of the things that became apparent immediately is that he had no concept of how to identify an edge. And so at the time, what I did was I taught him how to identify intraday support and resistance in the bonds using point and figure charts. And so we did that for a couple of weeks. And he went down to the pit. And and he had his, and it just so happened that, and he had his support and resistance, and found that he couldn't execute. I mean, he could not do it. Literally just couldn't do it. And that, of course, that really bothered him a lot, because he's the kind of guy that, he tells someone to do something, he expects them to do it. No mistakes, right? So anyway, no mistakes. And so what I did is I set this exercise up for him. And the exercise, now this guy's a multimillionaire, okay? And this exercise was really simple. And all he had to do was, we had support defined at a particular price intraday. We had resistance about 7 or 8 ticks up from support, whatever. It just so happened the first day that he had to do the exercise, the market, if the market's price came down to his support price, all he had to do was buy one contract. One contract in the bonds where one incremental tick was worth $31.25. And all he had to do was risk 3 ticks. In other words, he's going to risk less than $100 to see if this trade's going to work. And if he didn't get stopped out, then if the market went up to resistance, he had to get out of the trade and reverse his position and risk 3 ticks. In essence, whatever the market did first is what he was supposed to do. But in any case, all he had to do was risk $100. This guy's the kind of guy, he'd take a $100 bill and light a cigar with it. Seriously. He couldn't do it. Could not follow the rules. The market started coming down, and he got so panicked that it wasn't that the market, he got so panicked that the market wouldn't go down to his entry point, that he got in 2 ticks early, and then when the market went up 1 tick, he got out with a 1 tick profit. Okay, and what the market did, of course, it went down, hit his price, went up and rallied up to 7, 8 ticks up to this price here, and he did the exact same thing. He got in 2 or 3 ticks early. When the market went 1 tick in his favor, he blew out of the trade. Yeah, and so the next day he didn't really necessarily want to be talking to me after not being able to, he was embarrassed and that kind of thing. Next day he does the same thing. So I didn't hear from him for quite a while. And then about 2 or 3 weeks later, he finally called. And what had been happening is that he got really good at identifying these support resistance levels, these intraday support resistance, and he was actually making money, but he was still only hanging on for 1 tick. In other words, he was only hanging on for, every time just a one tick profit, and so he was calling to tell me that instead of learning how to hang on to his winning trades, he was going to compensate by upping his size. So instead of being a one-lot trader in the bond pit, he's going to up the size to 25 or 30 lots, okay? Now, the problem with doing that in the trading in the pit is that you're trading with a whole different group of guys. One-lot traders are going to be trading with other one-lot traders and some deck holders, but when you get to these upper levels, you're going to be trading with other guys, and if they don't know you or they don't like you, they can make life real hard for you. And I'm not going to give them the dynamics of the pit, but it's not like, what people think. But in any case, since they don't even exist anymore practically. But in any case, so he called back at the end, and I said to him, he didn't ask me for my advice. I did. It was unsolicited, but I said, his name was Jerry, and I said, Jerry, I don't really think this is a good idea. And he sort of grunted and hung up on me. So anyway, he called back at the end of the day, and he was in such a state of distress. Not only had he lost all his money that he made from the previous 2.5 weeks, I suspected that he lost, considering the level of distress, that he lost a lot more. And so it was so much, he lost so much, that he was genuinely at that point where he was saying, I'll do anything, and he meant it. He was so frustrated that he said, I'll do anything, and he really meant it. And I said, Jerry, if that's the case, then here's what you got to do. I want you to do exactly what you're supposed to do with one lot. And when you enter, when you hit support resistance, what I want you to do, once you're in the trade, I want you to actually put your hands in your pocket and watch the clock. And the market either hits your objective or you have to stay in the trade for 10 minutes, whatever happens first. In other words, I want you to put your hand, because with board traders, you trade with your hands. I want you to put your hands in your pocket and actually watch the clock, meaning I wanted him to be discomfort. Because as he watched those seconds tick by, those seconds would be like days and weeks to him. He wanted to get out of those trades. He wanted to take his profits so bad because he believed that, even though he could see, he just had indisputable evidence that the market would rotate back to his, support resistance points, that his fear of the market taking his money away was so intense that, he couldn't stay in that beyond that one tick. So I wanted him to put his hands in his pocket, watch the clock, and stay with the discomfort. And after the first day, he didn't think he did very well, but I thought he did great because he did manage, to stay in the trade for 3 or 4 minutes. Considering that each minute was like an hour or two to him, that was a big deal. It's like it wasn't really 3 or 4 minutes in real time. In his mind, it was a couple hours. Okay, really. And so, but the thing is, he did do it. And it was amazing how fast his fears dissipated to the point where he kept on doing it. And there was also his positive self-talk. In other words, I told him what to say to himself while he's watching the clock. In other words, to divert his negative thoughts and consciously think positive thoughts about, he knows why he's doing this and it's going to be all right. He's going to learn how to take his profits and, et cetera, okay? And, it wasn't really, I don't remember exactly how long it took, maybe about a week or so, and he was fine. He was done. He turned out to be a really, really good trader. Not in the pit, by the way. He left the pit and just became an off-the-floor swing trader. But he turned out to be a really good trader. Drawing energy. I've never had the kind of in-depth discussions with Jerry where I could actually identify and put into words exactly what beliefs he was operating out of that caused him so much fear. I didn't need to, but all I'm saying is that I didn't, he never really opened up to me in that way where I could say I knew exactly, I could put words on whatever beliefs he was operating out of, but it didn't matter. I didn't have to, and he didn't have to know either. All he had to know was who he wanted to be. He wanted to be someone who could hang on to his winning trades, and he accomplished that by stepping through his fear and staying with the discomfort long enough to do that, knowing exactly why he was doing it. And so you want to instill these beliefs, you're going to do the same thing. All you're going to do is you're going to do this exercise until you can do it flawlessly. Now, if you can do it flawlessly in a simulated account, then you're going to step into a live account. Now, how big of a live account are you going to step into? Meaning, what's your size going to be? I would say you keep your size. Everyone's going to be different, but you keep your size at a level where it is virtually meaningless. Meaningless. When it was a simulated account, it was definitely meaningless. Now you've got real money on the line, and so if you're thinking, let's say you happen to tap into a really good mechanical system, and you're thinking, you know what, I did my testing, and I did my simulated. Okay, now I'm going to trade 1,000 shares of whatever. Okay, and you're not, and what you don't know yet is that just because you did it flawlessly in a simulated account, it doesn't mean that you reconciled whatever money issues you might have when you go to a real account, okay? So I would say for some people, and there are people that I've worked with, for some people, their risk issues were so great that they couldn't even trade one mini S&P. They had to go down to one share of stock. One share of stock. Because what we're doing here is this, is that if we're working in a 20 trade sample size, that doesn't matter. If I'm saying, you know what, I'm not just going to take the next trade, I'm taking the next 25. See, that's what I'm saying. I'm not taking the next trade, I'm committing myself to take the next 25 trades no matter what. No matter what. That means that, in essence, what that implies, we'll do 20. I'll just do 20. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20. First of all, I don't have any idea what the sequence to wins and losses are going to be. I have absolutely no idea what the distribution or sequence to wins and losses is going to be over the next 20 trades. But what I'm saying is that I'm taking the next 20 no matter what. I know exactly how much I have to risk to take all 20 trades. I've defined my risk parameters for all 20 trades because it's exactly the same. So whatever that aggregate amount is, if you add it up for all 20 trades, if I'm trading one share of stock, for an example, and my edge dictates that I have to risk $2, let's say I'm trading a $50 stock, and I have to risk $2 to find out if my edge is going to work, then aggregate, what am I risking on this exercise? What? 2 times 20 is $40. Yeah, $40 plus commissions. Can we handle that? You think so? You'd be surprised. You might not be able to. So in other words, what you're saying is that I am willing to spend $40 to see what's going to happen with the next 20 trades. Now, if your risk tolerance is greater, and you can trade S&Ps or trade the Dow or trade the bonds or whatever that risk amount is, add it up on an aggregate basis, and assume that if I had to take 20 losses in a row, I'm willing to spend that money. This is really important. The chances of you losing 20 trades in a row is about as great as winning 20 trades in a row. So in essence, it most likely is not going to happen. But at least you are ready to spend the money if it does. It's really important that you make that commitment. And once you can trade whatever level you're trading at in terms of position size flawlessly, up your size. And until you can trade that position size flawlessly, up your size again. And how do you know if you've gone too far? You start making mistakes. You start getting conflicting thoughts. You start getting internal arguments. So then you scale back. How do you know when you are ready, if you so choose, to transition into the subjective or discretionary mode of trading, where you don't have to follow specific rules? How would you know when you're ready to do that? When you can trade at a position size that you normally would want to trade at, that your money management principles would dictate, and you can trade at least 2 sample sizes flawlessly. 2 in a row flawlessly. And what do I mean by flawlessly? I don't mean that you're just executing flawlessly. I mean that it doesn't even occur to you to do what you're not supposed to do. The thoughts don't even enter your brain anymore. I'm really serious about this, by the way. That the thoughts of doing something other than what your rules call for, it doesn't even occur to you because you've ingrained these principles into your identity at such a core level that distracting thoughts just they don't even come anymore. Or if they do, they're so irrelevant that you just immediately dismiss them. And when you are having problems and experiencing resistance as you're going through the exercise, what are you going to do? Focus on the beliefs that I just gave you, the ones you wrote down. These are the beliefs that you're energizing. These are the words that you're making real inside your mental environment so that you experience the world in a way that corresponds with these beliefs. Is this making sense, everybody?
Is it important to do these over a shorter time frame, i.e. like intraday trades versus something you might set up once a week?
Well, let's put it this way, Dan. It depends on how fast you want to get through it. You know, it's like you must set up an exercise on monthly charts. You know, it's like, and it takes you 2 years to get 20 trades. I mean, that's your preference, okay? It's like, remember, this is an exercise, okay? This is an exercise to instill beliefs that I'm categorizing as skills. These beliefs that I gave you, they are actually fall into the category of a trading skill. No different than being able to recognize patterns in the market. That's a skill. These are the psychological skills that correspond with being able to recognize those patterns in the market. Any other questions?
This is more of a comment, but when you said these are psychological skills, since 95% of trading is a psychological endeavor, this may be the only way to exercise those skills. It just made the connect. Because this is such a psychological endeavor, these are the skills you need to train. You need to learn them and gain them.
If you want to be consistent, yeah. If you want to create consistent results. Remember, none of these skills are necessary if you just want to experience winning trades. None of these skills are necessary if you just want to experience winning trades. They are absolutely necessary if you want a consistently rising equity curve where the drawdowns are simply a reflection of trades that didn't work, edges that didn't work, as opposed to psychologically generated drawdowns as a result of mistakes. See, what this exercise does is it instills in you a sense of trust that you will be able to do what you need to do, when you need to do it, act in your own best interest without having to experience pain first. Pain is not having to experience pain to do the right thing is not a good way to trade. I'll back here first. Go ahead.
I think you sort of answered my question in the last 2 sentences, but one of the things you mentioned earlier was you've got to know or have an idea of what kind of a trader you want to be. And I was just wondering if you could talk about, how do you get there? But I think, you talked about sort of how once you've gone through this exercise of, these 25 trades or whatever, however many, you build confidence in your ability to execute those trades the way your system is supposed to give you the signals, etc. So I think, and at the end of that exercise, you're much more confident about, your ability to execute those trades correctly, and also that you will not pull the trigger at the wrong time out of some other hidden agenda that you may have.
Keep in mind something. This is difficult to convey, but it's hard to know what decisions you're going to make about what kind of trader you're going to be when you're on the other side of this. See, if you're asking me, how should I decide what kind of trader I'm going to be, I can't answer that question because it'll be whatever resonates with you. And it's hard to know even at this point what that might be because you're going to be a different person. You're going to be seeing and responding in different ways, and it's hard to know what you might be attracted to and what might resonate with you once those fears are gone. Did that make sense? Someone here? Okay.
So in this system, this mechanical system, is it fair to set stop losses and automatic trades to enter and exit, or do you have to do it yourself?
You mean do it completely automated?
Yeah, completely automate the entry and exit.
No,
Do I have
no,
to
it
do
isn't going to help you to automate it. Just do it yourself. Because you want to experience what you're going to experience when you have to do it. That's right. It's either or. There's absolutely no judgment, no thinking wiggle room. You shouldn't even be thinking. Thinking is a trading error. All the thinking was done when you did your testing and decided on what criteria defines your edge. Once that's in place, no thinking allowed. There's nothing to think about. Just do it. Yeah, usually this should all be in the same market. You can say, the question was, you should be in the same market, yes. Whatever edge you're using, if you're going to set up multiple exercises in multiple markets for whatever reason, if you want to do it that way, do it, but just keep it consistent, that edge as it applies to that market. And time frame, absolutely, thank you, and time frame, right. Anything else? Okay, let's go have lunch.
Sitting there today, and he's writing down, what went well, what went badly, and making a plan for the next day. And that, to me, it was a real eye-opener because, again, most people are thinking to themselves, they want to make money in this game to live the easy life. And yet the reality of it is that most of these guys that have got all this money are working so hard. A lot of them don't have balance in their lives. That's just the way it is. So when I say somebody is, if you're not working on your edge, somebody else is, I mean that, these are the kind of hours that people are putting in. They're taking this game seriously. They know their statistics. They know their edge inside out and back to front. I mean, I personally spend a lot of time number crunching. So I crunch a lot of things to, when I see patterns in the market, I look at the probabilities of certain things happening. And sometimes I see guys call trades out, for example, on Twitter. And I think to myself, and I honestly don't want to come across in a kind of smug, know-it-all way, because trust me, I get it wrong, massively wrong from time to time. But sometimes I see people call these trades, and I think to myself, you know what? If you'd have done your homework, you would never be taking this trade because there's no, there's very, very little probability that you are going to see that. See that make money. For example, I might see them, trading a pattern that I know has a very, very low strike rate. And again, it's not to say that I'm always right, but this is what I mean when I say that people have done this work, and a lot of the time, they're the guys that, the newer traders are, making ill-informed decisions and ending up paying the bigger guys that have done the work and put that time and effort in.
Yeah, so you touched on it there, and the guy who made the huge wins for the day, he was still at the office late. He was the last one to leave. Do you yourself have a daily routine for preparation and reflection outside of market hours? And if so, I mean, what's the importance of keeping a trading journal? And is it important, what's important to record? What should people be writing in their trading journals as a minimum?
Well, the first thing I would say is that it's vital to have a trading journal. Most people don't, and even if they do, they maybe just log the trades, but they don't really examine them with the aim of increasing performance. You really have to look at your journal hard, and and really try and answer 3 questions. Right? Number 1, how can I make more money from my winners? Number 2, how can I lose less money from my losers? And number 3, how can I get more trade ideas? Okay. Now, in terms of journal, I would like to plug a company called Edgewonk, and I came across Edgewonk recently, and I think that they are doing incredible things in the field of journaling. I wish that had been around when I started out. I would have probably got profitable a hell of a lot quicker. But they're doing great things out there. But ultimately, there are so many traders out there that just do the same thing day in, day out, and they keep expecting a different return, but they're not getting anywhere. Now, I'll give you an example. I worked with a guy a while back, and he was really going nowhere, but he'd never taken a proper look at himself and his record and where he was going wrong. He would just say to me, oh, Tom, I think the problem is I'm making money, I'm giving it back, giving it back, I'm treading water. I just don't think there's anything really in my strategy. I think I need to learn a different strategy. And so I said, well, hold on, let's have a look at actually what you're doing. Can I have a look at your trade journal? And he'd actually got a trade journal. So, kudos to him for having a trade journal. He had it and he sent it over. Now, the first thing I noticed was that this guy's traded size was totally inconsistent. Like, one day he's doing a 4 lot with an 8 tick stop. The next day he's doing a 1 lot with a 10 tick stop. It made absolutely no sense. So I asked him what was up with that. I said, why are you varying your size so much? And he said, well, 2 reasons. I'm varying it based on my degree of confidence in the setup. So if I see a setup I really like, I put more size on. And he said, and sometimes I vary it based on confidence in my own ability. Like if I've had a bad couple of days, I'll lower my size. So I thought, okay, this is not good. But I said, okay, let's start with the setup. What makes you risk a 5 lot on setup A, but only a 1 lot on setup B? To quantify that for me. And he says, right, setup A is more likely to win. So I said, right, but based on what? What's the expectancy of it? So I'm expecting him to give me a strike rate, an average win versus average loss, some stats. And he says, no, just gut feel. So I'm thinking, right, so basically, when you've just got a good gut feeling, you're risking more. Okay, that for a start is clearly not working for you. You can see that from your performance. But then the next bit is even more problematic because it turns out that like many people, he'll do a 2 lot, right? He'll do a 2 lot trade. And if that 2 lot trade loses money, the next trade he'll do a 4 lot to try and make the money back quicker. Now, if that loses, he completely shits himself, and the next trade is on a 1 lot. And so many people do this. So they'll get, a loser, and that loser, they try and revenge trade it, and because they're not in the right emotional mindset, they've upped their size, and they then get really hit hard. And then rather than just take a break and come in and refocus, they then get so nervous that they go right back to tiny size. And then, of course, sod's law, they immediately get a winner. But it's on such a small size, it's had no impact really for them. And anyway, lo and behold, what I found out is over a decent sample size of trades, this guy had a really positive expectancy, but the guy's down money. And this thing happens to a lot of people on a much bigger scale. He had no idea that he had a winning strategy. All he thought is, I'm not making anything, the strategy doesn't work. And he hadn't realized it was due to varying his size. But when you crunch the numbers, it tells you that if he took every single trade on a 1 lot or every single trade on a 5 lot, he would have made money. And he would have made a lot of money. But again, people don't look at this. Something else, and I won't go too into this now, but something else is always worthwhile looking at is your maximum adverse excursion. So how far do your winning trades go against you? Let's assume for a second that you've got a fixed strategy where you have a 50 tick stop on every single trade and you have, a 50 tick target. So you're going for a 1R. And let's just assume that you win 100% of your trades. You win every trade. I know that's never going to happen, but let's just assume it. Now, you could look at your stats, and if you find out that the furthest price went against you in your sample size was 6 ticks, let's say, then guess what? You've realized your stop is way too wide. You're using a 50 tick stop, but the furthest price ever went against you is 6 ticks. You could massively reduce your stop, and your expectancy would go through the roof. But there's a lot of people out there that are just busy, patting themselves on the back going, look, I've won 100% of my trades, I'm absolutely killing it. But they're not working on moving forward. And this is something that, you should never forget is that you can always improve. There is nobody out there that can't improve in this game and that can't do something better. So for me, a journal is a very important thing because I come to it usually every quarter. I review my journal, and like I say, I'm trying to answer one of those questions and try and find a better way to do things. And once you've found a better way to do things, you've got to implement that. But yeah, I do think it's all about ultimately having a journal and recording the right things and studying it. And if you want to know what to record, the best way to do it is is, in my opinion, to at least go on YouTube and have a look at Edgewonk's videos, because they really, they really go to town on it. It's like their thing. It's what they know.
Yeah, that sounds really cool. I'm going to check that out myself, and I'll also put a link to it in the show notes as well. So, yeah, I mean, if you recommend it, I encourage that other people check it out also. Now, first one would be the video you recently made. It's a parody video on so-called trading gurus, which has been getting a little bit of attention. And, I mean, I thought it was quite entertaining. I got a good laugh from watching it. What was your reason for doing this? I mean, I presume you feel some kind of way about those who present themselves as gurus and maybe not qualified to do so.
The thing is, Aaron, I make a lot of jokes, right? And everybody knows that. And I feel that sometimes it's the only thing that kind of keeps the stress at bay, because it is quite a stressful job. And you need to have the ability to look at the market and just laugh, from time to time. Sometimes there are just the most ridiculous moves. And, if you don't laugh, you're going to end up crying, with your head in your hands. So I think it helps to have a sense of humor. But regarding that video, that specific video, there are so many people that just talk shit in this industry, and I can't help but want to parody it sometimes. For example, those that spout cliches like trying not to think about the money. Right? Now, that's actually very good advice. But they'll be saying try not to think about the money, and then their Instagram page is full of Ferraris and Lamborghinis, and I'm staying at the...
Okay, what's up, guys? So finished backtesting for the morning. Gonna do a quick review of current positions. If you guys do have any pairs you want to go over, go ahead, type in the live chat. If not today, if there are no requests, I'm just gonna stick with the pairs that I'm currently in, or the main ones I'm currently paying attention to, and gold and US30, because regularly reviewing those. Bitcoin, same setup, same thing, still see it as an amazing opportunity. And I'm gonna go over that too after US30. All right, so EJ still holding this position. I got in after this third hump here. I missed this first entry, missed this second entry, was able to get in on this entry, and just looking for price to continue to scale down. If that trend line breaks at any time, that's the only reason that I'd start to look for buys. Man, really is going letter by letter. Well, I guess in a different situation, I would want it to go letter by letter. Okay, yeah, that's EJ. Sell until the trend line's broken. Next, Euro USD, major reversal pattern. No real setup for me right now. Just looking for a buying opportunity eventually. Right now, just looking for price to continue to scale down. But this is more so a daily setup for the medium and high risk entry that I talked about in previous videos. But yeah, this isn't something that's like grabbing my attention at the moment. I'm not paying too much attention to that. GA is definitely not on my list. I'm on my practice session, am I not? I think I am. Yeah. Okay, that's more like a UJ. Now UJ, there's a possible expanding triangle, nothing for certain, nothing for sure, or no solid setup is what I mean right now. So this isn't really my setup. This is just what I'm looking for to happen. I like to see some resistance happen in this area, price break the trend line and give a clear sell setup. But until then, it's not really something It's not really a major setup right on here either, for me at least. I already talked about EU. AUD USD. Got that sell we were waiting on here. The entry came here and it came really, really strong. Then we got another entry here. I think I actually entered on this one, the major one. I'll have to go back and check. I either entered here or entered here. I'll double check that. And just looking for prices to go down. My TP, which I'm not going to estimate that. I'm actually going to make sure I get the right area. Stop there at about a 7-to-1 opportunity. Potentially looking for price to continue to scale down. In this situation, nope, not ready yet. But looking to move stops to break even pretty soon. Up 50 pips at the moment. Okay, GU. Also on a sell here. Now my analysis has changed on this. My original setup, and this was the prime setup of last week. If you go back and check the watch list, the link to my blog where I post my watch list is in the description, and should be one of the pictures posted. So the original setup was, let me just delete all that. There's a resistance level here. At this resistance level, look for a selling opportunity and wait for a, geez, come on now. Here you go. Alright, so said wait for a break of the trend line. The break of the trend line came. Look for that impulse, then wait for this corrective movement and enter at the top of this correction and look for a sell all the way down to the bottom of this range here. Now, I entered here for the sell, but this weekend I saw something else that could possibly happen, and currently I think it's more likely to happen simply because we have this huge impulsive move, and this could just form a corrective pattern. Now how deep that retraces and how it reacts at this certain level that I'm looking for a possible reversal at is going to depend. So right now this is what my position looks like on it, and this is the last position I have. Stop. I put my stop right above this level, I believe. I hope I did. I should have. Man, I really have to review my. Matter of fact, let me pause. Let me check on my positions real quick because I don't want to estimate this. I've lost my phone. Okay, I found my phone. Okay, yeah, at first that did not seem right. It's really, really tight. Why'd I place it there? I may have meant to place it above this level. Yeah, I meant to place it above this level, but I probably just was a few minutes late. That's a shame. Well, this is my position right now, and I can't expand the stop loss because it's going to What no, wait. Yeah. Okay, that's it. But that's it right now. My level's right here. Perfect. And this is the 1 hour setup. Okay, so originally looking for it to scale all the way down and scale down all the way down to this level. Now I'm checking to see what price it does in this area. Depending on what pattern forms there, I'm going to be looking at it on the 1 hour time frame. It's going to determine if I close this position or not. But I just know that this is a prime situation for me to just reevaluate the entire situation. Let me zoom in so it's clear. Okay, so scenarios that could happen: price comes down here, forms a descending channel, Dakota closes. Price comes down here, rejects, aggressively get a break of the trend line, Dakota closes the position. Price comes down here, breaks this level, closes below, Dakota holds the position, moves stop loss into profit, and continues just with the original setup. Because if that does happen, if we do get a new low here, definitely looking for this to just be a trend and looking for another position or another setup to come, and price to continue to scale down. Now ultimately on the higher time frame, on the higher time frame, long term, I would like to see price continue pushing down. I do need a cleaner setup on this time frame there, though, definitely. But that's about it on GU. JPY, nothing's happened. It's just the same thing. It's just been consolidating since last week. All right, let's go to gold. Jeez. Well, that buy did not play out. Yep. Alright, so had this descending channel here at this level, was looking for a potential buy at this area. Price just broke below and just went to the floor. Very, very aggressively. Right now, I'll just be looking for buy setups. Nothing that I'm gonna dig into right now. In this situation, I wouldn't even buy. I mean, I wouldn't look for a position, but definitely just looking for buys, because this is unsustainable movement to the downside, and we need some, let's just say, sustainable movement to the upside to even it out, to average price out. Let's go to US30. Nice. So we got the rejection up here at this level. No setups, no nothing. Okay, so we never got the break of this pattern to the downside, so there was no sell setup here. Price went up to the supply zone, and prices come back down. Now, if we just break market up section by section, also in this large range. Recently we have an impulse here, impulse down, we have slight corrective movement off the 15-minute time frame, and we have corrective movement moving to the downside. Now with this impulsive move to the upside, the low hasn't been broken, so we still have potential for this. Well, at this level particularly, we have potential for price to push up. The thing that I don't like is price just peaked above the supply zone and didn't really break all the way through it and form this formation. Price has dipped below this level again, so that's telling me not to go for the buy in this situation, because this supply zone tells me to look for sales, and if I have a buy signal in a selling area, I'm going to pay more attention to the area instead of the signal or the price signal. So in this situation, I have to wait. I'd like to see at least a slight push up, but ultimately looking for it to come back down a little bit more. I need a cleaner setup here. All right, finally Bitcoin. Now the opportunity I'm looking for Bitcoin is a buying opportunity. I'm looking for some strong buys to come up pretty soon. Like that right there, that's nice. Oh, like that right there, that's nice. That's beautiful. All right, so the buy that we got from this level played out perfectly. So originally we had this buying set up. We got that opportunity to the upside. Price came down. Said in this situation, if price breaks below this level impulsively, look for a correction and possible sell down to this area. And at this area, look for a buy. We had a descending channel here, so there was this opportunity here off the 1 hour time frame to look for a risky, mid risk, and high risk opportunity for a buying opportunity. I don't see a mid risk. I only see the high risk and safety risk entry for this setup, which played out and made new highs. Price is still just made new high, and we're just waiting for a correction and a possible push to the upside. So just waiting for a pullback for this impulsive move here. That's pretty much it. Let's go to the higher time frame, see everything that we need here. Let's go to the daily. Yeah, we need a pretty large pullback on the daily time frame. Testing this level here, or just above it. And that looks like it's it. So there are no requested pairs, no questions or anything like that. So I really appreciate you guys hopping on, watching me backtest, or listening to some audios with me or interviews. And I hope everyone has a good week. I'll catch you guys later.